Alright guys, welcome back to smarthelping.com. We've got a equipment rental business. A little bit of background: equipment rental, no matter what you're doing, is basically a cash flow business. You buy equipment, you rent it out. You don't have much operating costs. Your main concern is debt and getting people to rent out your stuff. Also keeping it legal, insurance, paperwork, all of that good stuff. But what I've built here is a really, really good cash flow financial model for an equipment rental if you're starting up. And it's really late on Sunday night, so I'm trying to get through this. I really don't want to. I want to, really explain everything about this model because it's probably one of the best I've ever done. I really like how it works, so I'm going to try to get you guys so you can see it working in action. Okay, so equipment rental. Number one, I'm just going to walk you through how the whole thing works because that's the easiest way to explain. So, well, you got to have some equipment. Right here, I've listed 100 possible equipment pieces of equipment to start, and this can be easily expanded to thousands of pieces of equipment if you had it without a problem. But I just started with 100 because this is more geared towards someone just looking to start up a business. Now, one of the most important things is, number one, make sure you have the demand for the equipment. Don't buy a whole bunch of equipment and then hope you get demand for it. If not, then you got to figure out how to get rid of it. You lose money. You got assets sitting around doing nothing. So you want to buy equipment as it is needed, and you grow in that manner. So what that means is the model has to allow you to enter various months where you start buying equipment. You're not going to buy it all at once. So we're not really going to have a nice like internal rate of return calculation, but we're going to have some really awesome cash flow uh, insights over time from this. It's really nice. So what you can actually do is put in the cost of the equipment, the date you start, and the date you get rid of it, and there will also be established values that you can put in. So let's just say, I just got names here, and if you change the name in the equipment item column, it will propagate through the model in the individual line items on the monthly and annual summaries. So let's just build a little. I'm going to build a little scenario that I'm just going to expand it out. Let's say this is not a mower. Let's say this is a dump truck, and it's going to cost you, I don't know, how much is a dump truck? Let's say a nice one, a huge one, let's say 250,000. Okay, and we're going to start it right on the first month that we got, and this will allow you to pick any month within the 10-year time frame. This model is a 10-year. So we're going to pick the first month of the first year, and then now we have another dynamic function. You will be able to pick by year the average amount of days you expect the equipment to be rented out per month. So let's say year one, you average 20 days a month. Year two, 25, and then you got up to around 28, and you hung in there at about 28 for that a month. Meaning it was basically utilized 95% of the time. Now that might not be the case. Whatever your research shows with your market and whatever knowledge you have, you might have a different numbers in here, and that's fine. That was the whole reason why it was built like this, is to give you complete control and dynamic functionality. Okay, so we got our dump truck. You can see dump truck, yep, it has updated right there. Now, how much are you going to charge? Usually rentals, it's a per day. So for the purpose of the model, we're going to say if we're renting it out to somebody, let's do $250 a day. Now it's going to matter more if you're trying to pay back debt, but if you're just all cash, then Your main concern is you want people using it, so maybe you lower your prices. It takes you longer to make money, as much money, but you don't have to worry about debt service or paying back loans, which is it's a huge part of the equipment rental business because it's pure cash flow. Your cash goes out to get the equipment, and then you slowly bring it back in with renting. So let's say at $250 a day, we have running costs here. I've done repairs and maintenance as a percentage of the total active assets, which is 1%. So let's say if you had $100 worth of assets, this is saying every month you're going to pay 1% of the total asset value for repairs and maintenance. Now it could be different, but that's a pretty good number, or pretty good field to use percentages in, so you can estimate. Then you've got all your regular operating costs like legal, accounting, utilities, rent for your office or buildings, for storage, just general and administrative, and then all these other costs that you might have. So let's just say G&A is at $500 a month. Pretty small operation we got going so far. Legal, let's say $100 a month, and accounting's $200 a month. Utilities $250 a month. Yeah, so $150. Now you don't have much. There's not that much running cost to this, or even cost of sales. Your main expenses is going to be your debt. And if you don't have debt, then your main concern is how fast can you get your money back from the cash you just put out. Rent, let's say rent's I don't know, $1,500 a month for your office. Then the rest of these expenses, just to show you that they will propagate through the model, we'll just put $1 in there. Alright, so we've built our initial business. No debt at the moment. One piece of $250,000 equipment that we're renting at $250 a day. So let's quickly look at the monthly annual. So the monthly is going to show you the dollar amount of your revenue per item, all 100 items here. And it's going to be time based, so you can see this starts in January. If I were to have switched the start date on this to, let's say, May, you can see, oh, look at that, the revenue doesn't start until May. So great, that works. So there's the revenue per equipment item, rental income. We've got the total rental income, then we have all our operational expenses, like I said, the repairs and maintenance, general legal. It's all pretty cut and dry. Our net operating income, or EBITDA. And then here is the important part. We have row 133, which is non-depreciated asset value. So this is taking into account all equipment purchases, all equipments that have been discontinued, which means if you put in the end date, and let's say we do it in 1 year just to show you the functionality, you can see right there popped in, it closed it out January of 18 as a minus. Now that's not going to affect the cash flow. What will affect it is if you put a salvage value in here of, say, I don't know, $1,000. You can see the numbers update down here. If we just have nothing there, then you see our monthly cash flow is at $3,790. If we put in, say, 1,000 salvage there, it goes to $4,790. So this is not really going to be for reporting, for accounting purposes, but the main thing you would use this model for is to check how you're actually doing versus what this model was that you built. So this is like your forecasting and budgeting. So you might want to have 2 copies of this Excel sheet up at once. One's the model, and another one is where you're actually putting in real numbers. You can see how you're doing, and then the model itself will help you project, your cash needs. given your scenario. Alright, so again, that doesn't affect cash flow. You can see the running position didn't change much from here to here. Well, probably changed about what happened. Looks like our revenue went up January of 18. Oh, because we went up to 28 days from 25. Okay, that makes sense. And I'm glad that's working. So, running cash position. Again, this is not going to affect it. You see we went from negative 249 to negative 245 after that month. And there's no debt service at the moment. When I do put in the debt service, you will actually be able to dynamically see the monthly debt payments on 4 different loans, starting at 4 different times. So you can see here, month of financing, you just pick the month. It's a drop down. You pick the amount financed, the loan term, the interest rate. Based on this information, you will then have debt service populating. So let's just say we financed the whole $250,000 of that equipment item on a 30-year loan at 5% interest. You can see there we now have a debt balance. We now have debt service here at $1,300 a month. And how's it? Oh, that's negatively affecting our cash flow until we hit positive up there. So at the current usage, we've got 6,250, and I've got groups here so we could kind of show the revenue and costs all here. So if you can see in January of 18, we've got revenue of 6,250, cost of 24, our EBITDA is 30,790. That's basically what we have left over to pay for anything else like debt. We have we've now put this out of service. We have and note, this is important. If you do take this out of service, we say here we did it in year 3, you would then want to put zeros after that. So if you're discontinuing an item, make sure you close out that item. And actually, I probably should put a function in here because you won't always be closing out, at the exact end of each year. So 1 second, I'm actually going to add functionality. So whatever you put in here as a date, the revenue for that item will then no longer populate standby. Okay, there we go. It's fixed. So you can see here, we now no longer have revenue if we discontinue the item, which makes complete sense. And now it's not an annual basis, it can be granulated as far as monthly. Let's say we put this all the way out to February 2020. You can see now this should have revenues. Yeah, EBITDA is up to 2020. And then you can see the May, see, February, it goes from positive to negative, which means we should have zeros up here. Perfect. Okay, so the formula is working. We only have one item at the moment. Okay, great. So that, it looks like everything's working. Excellent. Now the nice thing, look at this. We have visuals. Now obviously this is negative because we've stopped revenue midway through. So let me just put this back. I've added 1 month to the end, so then if you pick that, it goes into the full 10 years. And here we go. So interesting right here. Now it says our outstanding debt, you can see it's going down slowly, 30-year mortgage. The darker shade is our uh, revenue or running cash position. Getting up there, it's at 50,000. Then we have non-depreciated asset value, which is just 250 at the moment. Nothing's changed there. We've got rental income. You can see the step-ups when we add days utilized. The expenses are the same because I just made them the same for every year. Profit margin, same kind of, follows the same kind of deal as the rental income, because our profit margins are going higher as more days are utilized for rent. Then we have same charts but on an annual basis. This is the profit margin. Then we've got rental income versus operating costs. Then we've got cash position to debt, and you can see the debt or the cash position a little bit better there. See, it's only going up about $8,000 a year. The debt's going down about $5,000 a year. So you're paying off your loans, you're still building some cash, you're making money, but the equipment is quite a bit. Now let's say you have 125,000, so you only want to fund half of it. So let's say we only finance half here. Now let's see how this affects everything. Well, you're starting more negative because you actually don't have the cash to cover the cost of this asset, and that's where this negative 125 is telling you, well, you don't have enough money to cover the debt service, or you don't have enough money to, you have to, this is saying the loan is not covering all the money, or if you have zero in the loan, you can see this would just go to 250 if we make the loan zero. 249,960 because you got $40 of income in the first month. So it's saying either one way or the other, you got to either finance 250,000 or you got to put it out of pocket. Now, if you do put it out of pocket, you could use the salvage manual input to put that there. So let's say we did put 250,000. Now our running cash position is basically just the EBITDA, and the reason why is because we don't have any debt. We put up all cash, so now you can see, well, it's going to take you the full 10 years, and you still won't. You'll be $209,000, so you still haven't paid yourself back completely. And here's a better visual of it on the annual side, because that is not, because this is manual here, so the annual I have not put that 250 in, so it's saying you start at negative, which you might want to just do that. If you do start at negative, it tells you when it gets to zero, well, that's your break even on your, on the whole business. So maybe we just leave that blank, and same deal here on the monthly. Let's start adding. So you can see how nice this is. If you have a really good plan, you can figure out, what revenues you want to charge. Let's just start adding some stuff here. Let's say we have, $25,000 mowers, a couple of these, some tractors for 50,000, a couple of those, and let's say the start date is, we're gonna go May, then August. We'll go into next year, March, April. Was it April? June. And let's do another June 18. For the rest of these. And we'll say, let's say they're even just half utilized. So let's just do 15 days a month. Oh, don't want that to pull over. And this is just manual input, but I'm just using some formulas just to make it go quicker for myself. So say we're using them half the month. They're all going the full 10 years. And start dates. Let's see how the annual looks. Actually, let's just look at the visuals. Well, now, well, it's low, and that's because we're not charging enough. Well, we haven't even put any numbers in here. So for the $25,000 mowers, let's say we'll charge $100 a day for those. For the tractors, they're a bit more. We're not going to double it, but we'll charge, say, $150 for those. And how far down do we go to tractor 5, I think? Tractor 4. Running costs. There's basically only one variable running cost. The rest of everything is fixed. Alright, now what are we looking like? Okay, there. Look at this. So we're getting down to the most cash you would actually need to put into the business. If you had to put it out of your pocket is $500,000. In the first couple months you're looking at about $250, $290, and that means you're either gonna have to get financing or you put it out of pocket. Now if you put it out of pocket, you can see your break even is, assuming you start with all this scenarios in January of 17, your break even is right here around, what is that, January of 2021. And then you're cash flow positive. You made your money back. Here's the asset value. You can see as they kind of go up, and then we stick there. Because I didn't add anything down the road. Profit margins. Now here's interesting. You can see it on an annual basis. Rental income versus operating expenses, cash position to debt. No debt, so there's no debt marker there, and then profit margin on an annual basis. So let's look at this. So we got our chart says we need about 498,000, but now if you think about that, if you add debt, your cash flow is going to be a little bit less because you also have to pay the debt service. So let's go ahead and see if now we can stagger these two. So let's say we do 250,000, and then what's our next big purchase? In June of 18. So let's make June of 18 the next loan. You see how this goes, and now how much did we purchase there? 225,000. Okay. So we've got, now let's check it out. That's a nice chart. That actually makes sense. So there you can see we're slightly still in the red. We actually don't have enough cash. We're 59,000 in the red. You can see in 2018 negative 212. Running cash position. What do we got here? Net operating income 114. Just looking at 2018. Let's check this. I actually didn't run this check yet. Running cash position, or running cash. 8452. Now what is off about that? Now those should match, so let me check. Stand by. Okay, got it. So the annual P&L, the funds from financing, which you can see here, is pulling whenever there's a finance amount that populates into here. Well, the annual P&L, the formula was not updated, so now it is. So now you can see it makes sense that our lowest point is negative 49,000. So we actually did not get enough financing. We still need to either put more of our own cash in or get more debt. So let's say we do let's do 280. Still negative. What are we down? 49. Oh, right, because that's in the first one. We don't actually need more here. We need more in the first initial deployment. Do 290. Almost. It's negative 11,000 because that debt service of 18,000 is just hurting. Let's try 300. And there we go. I think we did it. So you'd have to put in 2,600 bucks of your own money. But you're also paying, this is assuming you're making, your revenue is 79,000, your expenses are 62. So you're taking in 16,000. From that 16, you got to pay out 19 in debt service. So there's where the makeup is. Now the next month, you got a little bit more revenue, 114,000, because we've now started a couple more pieces of equipment. Again, these are only half utilized at the prices I set it at. 100 bucks, like you remember we did 100 bucks, 150, and we only utilized all these for half of a month. And now at 198,000 in revenue, we got running costs at 83. Most of it's just repairs and maintenance. That might be less too. Probably is going to be less on that amount of equipment, but you never know. I don't really know. You'd have to be. The key is the functionality is there. So if you're looking at the construction business, you will know those numbers and can plug them in where relevant. The key is that you can actually plan it out and see the effects of cash flow. All right, so month 2, 114,000. We're purchasing 250,000, but we also have a finance coming in that year as well, 225. We got a little bit more debt service for that second loan, but now look, debt service 31. Our cash flow is positive 58 because we had enough operating income to cover all of our new debt, and we financed enough to purchase new equipment, and now it's cash flow positive from there. So you can see as we're going forward in time, the running cash balance is getting higher and higher. Again, you can see with the visuals in there. The running cash position against the total debt. Now I thought this was interesting. I put total debt position as well. Now why in 2019 is that higher? Trying to see if that makes sense. 2019. That starts in 18. Why is this coming in? Oh. Now here's a little bit of a discrepancy. So, and it's just a formula. It's just how it kind of works. It's looking up the first day of the year on each of these. So in 2018 in January, we actually got this loan out in June. Now if we put this back to January, you would see it would then come into 2018. And then you would not see, you'd see the spike in 2018 instead of 19. But the key is, it's the closest you're going to get to projecting out cash flows with such dynamic capabilities. I mean, I really like this cash position to debt position here on the monthly. That's a really, like a good view of what is going on a consolidated basis with the whole business. You see 1, 2, 3, and 4. These tabs all just have the amortization schedule for all 4 loans. Let's see the visuals monthly. Make sure this is at the top and expanded. I think we're about there. And hopefully I haven't done this much of a disservice because I'm feeling under the weather and it's late on a Sunday night. But I've worked on this thing a lot today and I'm pumped that it is where it is and it works as it does, because this model is just really one of the best ones I've built. It will be an upper tier model 100%. There we go. So now all 10 years fit without having to move cursor over. And I'm pumped about this thing. It's awesome. Hopefully you will be too. And if you want to purchase a template, you just go to, I'll have a link in the description box below to smarthelping.com, right to the page where you can purchase it. If you do so, I'll send it right to your email, probably within 5 to 10 minutes. And I will fix any errors or any logic that needs fixed that's not correct if you find it, which I've just tested it pretty extensively here and it seems to be working. I fix for free any extended logic that you want that's outside of the scope. I'll just charge my normal billing rate of $40 an hour if you want me to do that. So I'm going to clear, well no, I'll leave this in here, so the actual default template will have some figures. You can clear them out when you get it, but you may want to have them in there just so you can see how it works. Alright, that's all I got for you. And this is the equipment rental financial model, cash flow intensive insights. Have a great start of your week.